Hi, welcome. This is Isoma Diary. This course is titled Fixed Income Securities. Now, the course is divided into 6 topics. This is the very first topic and is titled Reading 51 Fixed Income Securities Defining Elements. Now, what are you expected to know in this class? Now, the candidate should be able to A. Describe basic features of a fixed income security. B. Describe content of a bond indenture. C. Compare affirmative and negative covenants and identify examples of each. D. Describe how legal, regulatory, and tax considerations affect the issuance and trading of fixed income securities. E. Describe how cash flows of fixed income securities are structured. And finally, you should be able to describe contingency provisions affecting the timing and or nature of cash flows of fixed income securities and identify whether such provisions benefit the borrower or the lender. Now, basically, fixed income security is a prevalent means of raising capital or borrow money from investors. Now, the promised payment, that is the interest and principal, are actually contractual. What that means is that the issuer or the borrower is bound to pay these contractual payments, the interest and the principal. Now, unlike share ownership, debt investors do not have ownership rights. What they have is basically a prior claim on the cash flows of a company. Now, fixed income securities or bonds are contractual payments. Like I mentioned, a prior claim on a company's earnings and assets. Now, they can be used to fund future obligations such as tuition and pension payments. In the portfolio context, if you add fixed income to a portfolio, actually can benefit from what we call diversification. All right. Now, in this class, fixed income securities, sometimes experts and even non-experts also call them debt securities or even bond. Now, let's look at the difference between traditional and non-traditional bonds. Now, traditional bonds are the one we are more familiar with. These are basic bonds that the issuer issues and promise to pay interest and principal at maturity, and usually maybe there's some form of collateral. Now, we also have what we call non-traditional bonds. These are bonds that are created from a pool of assets. Now, we call that process securitization. We're going to go into this in much later in some other topics in this course. Now, basically, the bond issuer will create an entity called a special purpose vehicle. Now, the special purpose vehicle now will buy up a pool of assets, and from this pool of assets, it creates bonds, which are called asset-backed securities. We'll go into more of this in subsequent classes. Now, let's look at the basic features of a bond or a fixed income security. Now, the first we want to look at is the issuer or the borrower. Now, let's see the types. Now, sometimes supranational organizations also issue bonds. When we say issue bonds, you are trying to raise money by borrowing from investors. Now, supranational organizations include the World Bank, the European Investment Bank, the African Development Bank, the Asian Development Bank, and so on and so forth. Now, sometimes also sovereign national governments, such as the United States of America, Chinese government, Japan, Nigeria, United Arab Emirates, and so on and so forth, also issue bonds. They also borrow money from investors. Now, the third category of issuer are what we call non-sovereigns, such as state governments, what we call, sometimes they also call municipal government in some other jurisdictions. Fourth, now we also what we call quasi-government entities. Now, quasi-government entities are basically entities sponsored by the government, like the Postal Service. Now, in the context of asset-backed security, we are going to be talking about the Fannie Mae, Freddie Mac, and Ginnie Mae. Will come to all that in much later in this course. And also corporate entities like Samsung, Amazon, any group, and so on and so forth also issue bonds. Now, bondholders basically are exposed to credit risk. Now, what is credit risk? This is the risk that the borrower, the issuer, may not be able to meet the contractual obligations to make the periodic interest payments and principal repayment and maturity. Okay, now bond markets are classified into what we call investment grade and non-investment grade. Now, investment grades are less risky. These are instruments that have very good rating and carry low or lower credit risk compared to non-investment grade, what we call speculative high yield on junk bonds, which carry quite a lot of credit risk in them. Now, most financial institutions like banks and insurance companies are heavily regulated in terms of the kind of bonds they can carry in their portfolio. All right. Now, for the issuer, investment grade rating implies lower credit risk. I mentioned that earlier on, therefore lower yield. Now, what we're saying is basically is that an investment grade rating implies that the issuer, when an issuer has an investment grade rating, now you can actually borrow at a lower rate, meaning it will cost the borrower less to borrow than a high yield issuer who would need to pay a lot of interest, higher interest to attract investors. Now, another feature we want to look at is maturity. Now, let's see how bonds can be structured in terms of maturity. Now, maturity date basically is when the issuer or the borrower is expected to repay the entire bond obligations. That is basically repaying the principal at maturity. For example, you can have maturity ranging from overnight for very short-term instruments to as long as 30 years, even more. Let's see how maturity can take. Now, the first thing we have what we call money market securities. Now, these are basically securities that can mature within less than 1 year, meaning if the issuer borrows through a money market instrument, he is expected to pay back within a year. Now, examples of these money market securities are what we call CDs, certificate of deposits, and CPs, commercial papers, and treasury bills. Now, capital market securities, these are basically instruments or bonds instruments that mature over a year. We also have what we call perpetual bonds. These are bonds that don't have actually maturity, like the consols issued by the UK government. They can last as long as 100 years. Now, the next feature I want to discuss is par value. Now, par value basically is the principal amount, what we call the nominal amount, sometimes also called the face value or the par value. You need to be familiar with some of these terms. As we go on in this class, you're going to see how relevant they are. Now, also have what we call the bond price. Now, normally bond prices are quoted as a percentage of the par value of the nominal value. Par value could be something like, say, $1,000, and then the bond price is quoted as, say, 90% of the par value, meaning 90% of $1,000, which is $900. The next feature I want to discuss is coupon rate, or what we call the nominal rate, and their frequencies. Now, what is coupon rate? Now, this is basically the interest that the issuer agrees to pay the bond holders. Now, the bond holders are the lenders. These are people that have bought the bonds. These are people that enable the borrower to raise cash. And so basically, just like any borrowing, when the issuer issues a bond, he promises to pay the borrowers periodic interest. And we call this periodic interest the coupon. So the rate could be 5%, 6%, 7%, 8%, 10%, depending on the risk around the bond. Now, coupons could be paid annually, it could be semi-annually, it could be quarterly, it could even be monthly. Now, annually means every year the issuer, the borrower, will pay an interest to the bondholders. Now, semi-annually means twice in a year the issuer will pay the bondholders. Quarterly means 4 times, and monthly means 12 times. Now, please note that coupon is calculated as a percentage of the par value, not price. This is very, very important to know this. You're going to see more of this much later on. What we're saying is that if coupon is stated as, say, 5%, 5% is basically 5% of the par value, not the bond price. Okay, now, coupon can be fixed coupon, what we call plain vanilla or conventional bonds, meaning over the lifetime of the bond issuer pays a fixed rate to the bondholders. It can also be floating rate note, what we call FRONs. Now, floating rate basically pays a floating amount of coupon. Now, how is this structured? Basically, you have what we call a reference rate and then a margin or a spread. The reference rate could be benchmarked to a popular benchmark like the London Interbank Offered Rate, popularly known as LIBOR. Now, the advantage in a floating rate note is that it resets the coupon, the amount you collect as interest, resets periodically. And what that means is that a floating rate could be something like LIBOR plus, say, 150 basis point. Usually the margin or the spread is in basis point. Now, what do we mean by basis point? Now, 100 basis point is equivalent of 1%, equivalent of 1%. So you may have a floating rate bond being quoted as, or floating rate note being quoted as LIBOR plus, say, 100 basis point, meaning the LIBOR at the time, the particular LIBOR plus 100 basis point. Meaning if LIBOR is going up, you're going to get more interest. If LIBOR is going down, you get less. So basically it resets, periodically. Now that spread, that is the basis, which is expressed in basis point, is basically a function of the issuer's perceived credit worthiness. Meaning if you are more credit worthy, you pay a smaller spread. If you are less credit worthy, you pay a higher spread. Now let's still discuss more on LIBOR. Now, what is LIBOR basically is a rate that international banks borrow among themselves. It could be 1 day, 30 day. You have 1 day LIBOR, overnight LIBOR, 30-day LIBOR, 60-day LIBOR, 90-day LIBOR, 180-day LIBOR, even 360-day LIBOR. Now these are rates basically that banks borrow among themselves. It's a major benchmark. Now let's look at zero coupon bonds and see how the rates are determined. Now for a zero coupon bond, we call it zero coupon bond because it doesn't pay you any coupon over the lifetime. You only just get the principal at maturity. So what then? How do you get, what is the interest you get? The interest is an implied interest. Normally zero coupon bonds are usually quoted as a discount, at a discount to the par value. Let's say for example the par value is $1,000. A zero coupon bond may be quoted like, say, 90%, meaning $900. So let's say if you have a 5-year bond, now what that means is that you're going to earn the difference between the par value at maturity, which is 1,000, and then the bond price, which is 900, which is 100 over 5 years. All right. Now another basic feature I want us to discuss here is, or we're expected to discuss here, is currency denomination. Now, bonds can be denominated in different currencies. It can be denominated in the local currency, can also be denominated in a foreign currency. Now, liquidity and volatility are very key factors or consideration that influences the return you can get from a bond. Now, usually emerging market issuers would prefer to issue bonds in a foreign currency like the US dollars, the euro, the Japanese yen. Now, why would they want to do that? Now, let's say you are an emerging market issuer and you are expecting cash inflows over, let's say, 10 years. At the same time, you need some capital, you need some money, some funds to embark on some project. Now, you can actually issue a foreign currency denominated bond. Let's say if you are expecting, let's say, cash flows in, say, euro. Now, you can actually issue a bond in euro. Now, what you have basically is a natural hedge. You are paying out periodic interest and principal. At the same time, you are also receiving an amount, all denominated in what? In euros. So we call that a natural hedge. Now, next we want to look at is what we call dual currency bonds. Now, what are dual currency bonds? These are basically bonds that pay interest and principal in different currencies. Interest could be in Hong Kong dollars, and the principal could be in Japanese yen. Another example we want us to look at is a currency option bond. Now, what is a currency option bond? This is basically a single currency bond with a foreign currency option. Basically, this is a bond that gives the holder an option to choose what currency to receive interest payments and principal payments. Now, these are all features that are embedded in a bond to attract bondholders or investors. Let's look at yield measures. Now, the first yield measure I want to discuss here is current yield or running yield. Now, what is current yield or running yield? This is simply basically the coupon as a fraction of the bond price. is analogous to the dividend yield, same thing as the dividend yield, which is dividend divided by the equity price. And the next concept is very, very important, the yield to maturity. You need to take note of this. You're going to be seeing this from now on till the level 3 program. Now, yield to maturity, basically also called yield to redemption or redemption yield. Now, this is the bond's internal rate of return. Is the return you can get from a bond if you hold the bond to what? Maturity. It's as simple as that. Okay, now the expected return if the bondholder purchases the bond today and holds it to maturity is basically what we mean by the internal rate of return. Now, it equates the future cash flows with the present value of the bond. You need to take note of this. It's a very critical concept you need to know about. Now, still discussing basic features, let's look at the relationship between the bond price and yield to maturity. Now, this relationship is very, very critical. You need to understand this. These are areas you should expect the CFA, should expect, questions to show up. Now, there is an inverse relationship between the yield to maturity and the bond price. What does that mean? If the yield to maturity is going up, the bond price will go down. The yield to maturity is going down, the bond price will go up. So we say there's an inverse relationship between the yield to maturity and the bond price. Basically, yield to maturity is the discount rate. All right. Now, sometimes when bondholders expect a fall in interest rate in the future, now what they do basically, they are actually expecting, they buy these bonds because they expect a lot of capital gain from such bonds. Okay, now this is the end of this introduction to this class. We're going to go much deeper into some other concepts in subsequent class. Thanks for watching.